Picture this. Sarah, a talented graphic designer, finally takes the leap to freelance. No more annoying boss, no more rigid hours. She's buzzing with excitement, landing clients, and watching her bank account grow. For months, everything feels amazing. Then, tax season arrives. She opens that dreaded envelope, sees a massive number, and her heart sinks. What is this self-employment tax? Why is it so high? Sarah just got hit by the ugly truth, and she's not alone. This is a story that plays out for countless self-starters. Before we dive deeper into Sarah's struggle, let's make sure we are all on the same page. What exactly does self-employment mean in the eyes of the taxman? Simply put, you're self-employed if you work for yourself. This includes freelancers, independent contractors, small business owners, and gig economy workers. If you're not an employee getting a W-2 from a company, chances are you're self-employed. And with that freedom comes a unique set of tax responsibilities, especially one often overlooked monster, self-employment tax. Many new freelancers, like Sarah, assume self-employment tax is just another part of their regular income tax. But that's where the ugly truth starts to emerge. Self-employment tax isn't just one tax. It's actually two crucial federal taxes rolled into one. It's your contribution to Social Security and Medicare. These are the programs that provide retirement benefits, disability income, and healthcare for millions. As an employee, your boss splits these costs with you. As a self-employed person, you pay both halves. It's a significant chunk, and it catches many off guard. Let's break down those two components. First, Social Security. This part of the self-employment tax funds retirement, disability, and survivor benefits. For 2024, the Social Security tax rate is 12.4% on your net earnings up to a certain annual limit. That limit changes each year, but it's usually quite high, meaning most self-employed individuals will pay Social Security tax on a large portion of their income. It's a vital program, but seeing that percentage applied to your hard-earned money can be a stark reminder of your responsibilities. Then there's Medicare. This portion of the self-employment tax helps fund healthcare for Americans over 65, and for some younger people with disabilities. The Medicare tax rate is 2.9% of your net earnings, and here's a kicker. Unlike Social Security, there's no income limit for Medicare tax. You pay it on all of your net self-employment earnings. So, combining Social Security and Medicare, the total self-employment tax rate comes to 15.3% on the first portion of your income, and then 2.9% on everything above that Social Security limit. It adds up fast. So, why does it feel like a double whammy for the self-employed? Let's compare. If you're an employee, your employer pays half of your Social Security and Medicare taxes, and you pay the other half through payroll deductions. Each of you pays 7.65%. But when you're self-employed, you are both the employee and the employer. So, you're responsible for both halves. That 7.65% effectively doubles to 15.3%. It's not a penalty. It's simply paying what both parties would have contributed if you were an employee. But it definitely feels like a lot more money out of your pocket. This 15.3% comes on top of your regular federal income tax, state income tax, if applicable, and any local taxes. Imagine running a small business, feeling like you're finally making good money, only to realize a significant portion of your profit is earmarked for these taxes. This was Alex's story. He started a successful online store, reinvesting every spare penny into inventory and marketing. He was growing, but he wasn't setting aside money for taxes. When the bill came, it wiped out his entire growth fund, setting his business back months. The shock was immense. One of the biggest myths people believe is that self-employment tax works just like the taxes deducted from an employee's W-2 paycheck. This couldn't be further from the truth. With a W-2, your employer handles withholding these taxes throughout the year. You rarely see that money, so you don't feel it as much. But as a self-employed individual, you're responsible for calculating, saving, and sending in these payments yourself. It's a huge shift in responsibility and a common pitfall for the uninitiated. Think of it this way. When you're self-employed, you essentially become your own invisible employer. And like any good employer, you need to manage your payroll taxes. This means setting aside money from every payment you receive, as if you were running a mini HR and accounting department for yourself. It's a mental shift, requiring discipline and foresight that many entrepreneurs, especially when starting out, simply aren't prepared for. This invisible employer expects its share, and it expects it on time. Adding to the complexity, the IRS doesn't want to wait until April 15th for all your self-employment tax, or your income tax for that matter. If you expect to owe at least $1,000 in tax for the year, you're generally required to pay estimated taxes quarterly. That means 4 times a year, in April, June, September, and January, you're expected to send a chunk of money to the IRS. For many, this is the biggest shock, as they're used to only thinking about taxes once a year. Missing these payments can lead to penalties. Let's meet Maria, a talented web developer who started her own agency. Her first year was a whirlwind of projects and deadlines. She knew she had to pay taxes, but the idea of quarterly estimated taxes felt abstract, something she'd deal with later. When April 15th rolled around again, she hadn't made any payments for the previous year's earnings. Not only did she owe a huge lump sum for all her income and self-employment taxes, but she also got hit with underpayment penalties. It was a brutal lesson in tax planning, turning her profit into pure panic. At this point, you might be thinking, why is this so complicated? Why does this tax even exist? It's a fair question. The reason is simple. Self-employment tax ensures that those who work for themselves contribute to the same vital social safety nets as traditional employees. Social Security and Medicare aren't optional programs. They provide crucial support for millions of Americans, our parents, grandparents, and future selves. So, while it feels like a heavy burden, it's a necessary contribution to the collective well-being. So, who is most affected by this ugly truth? It's often the small, independent operators. The budding freelancer just starting out, the artist selling crafts online, the local handyman, the dog walker, the tutor, anyone who is good at their craft but perhaps less experienced with financial management. These are the people whose earnings might fluctuate, making quarterly estimates difficult. They often don't have the budget for an accountant from day one, leading to these painful self-discoveries. The impact is felt most acutely when money is tight. The immediate consequence of not planning for self-employment tax is significant financial strain. Imagine building a careful budget for your personal and business expenses, only to find you need to suddenly fork over thousands of dollars you thought were yours. This can mean delaying investments in your business, putting off personal savings, or even going into debt. It forces tough choices and can erode the financial stability that self-employment was supposed to bring. The dream of financial freedom can quickly turn into a financial trap. Beyond the dollars and cents, there's a serious mental toll. The stress of unexpected tax bills can be immense. It can lead to anxiety, sleepless nights, and a feeling of being overwhelmed and out of control. It saps the joy out of what should be an exciting journey of entrepreneurship. Many self-employed individuals feel isolated when facing these challenges, believing they're the only ones struggling. This emotional burden is a silent, often unseen, part of the ugly truth. Another common myth is, if I don't make much money, I don't owe self-employment tax. Unfortunately, this isn't true. While there are income thresholds, they are much lower than many people expect. For example, if your net earnings from self-employment are $400 or more, you generally have to pay self-employment tax. This means even a part-time side hustle or a small consulting gig can trigger this tax obligation. Many hobbyists or part-time freelancers get caught by this, suddenly realizing their extra cash has a mandatory deduction. Ironically, success can sometimes feel like a trap if you're not prepared. As your self-employment income grows, so does your self-employment tax burden. What started as a manageable percentage on a small income becomes a much larger dollar amount as your business scales. This can be exhilarating and terrifying at the same time. You're making more money, but you're also seeing a bigger chunk disappear to taxes. Without proper planning, growth can lead to an even bigger tax shock down the line. Now, for a ray of hope. While self-employment tax can be daunting, there are ways to manage it. One of the most powerful tools in your arsenal is tax deductions. These are business expenses that you can subtract from your gross income to arrive at your net earnings from self-employment. Remember, Self-employment tax is calculated on your net earnings. So, the more legitimate business expenses you can deduct, the lower your net earnings, and thus, the lower your self-employment tax will be. This isn't cheating, it's smart tax planning. So, what kind of expenses can you deduct? Think about anything that is ordinary and necessary for your business. This could include things like office supplies, professional development courses, business software subscriptions, marketing costs, home office expenses, business travel, and even a portion of your health insurance premiums. Keeping meticulous records of all these expenses is absolutely critical. Without proof, you can't claim them, and you'll miss out on valuable tax savings. Liam ran a small photography business. 4 years, he only tracked his income, thinking that was enough. Then, a friend told him about business deductions. He started tracking every roll of film, every lens purchase, editing software, website hosting, even the mileage for client shoots. The difference was astonishing. His net income, and thus his self-employment tax, dropped significantly. He realized he'd been leaving thousands of dollars on the table, essentially paying taxes on money he'd already spent on his business. It was a game changer. Here's another powerful deduction that often goes unnoticed. You can deduct 1/2 of your self-employment tax from your gross income when calculating your income tax STAR. Yes, you heard that right. The IRS allows you to reduce your overall taxable income by half of what you paid in self-employment tax. This isn't a deduction from your self-employment tax itself, but from your adjusted gross income, which can lower your total income tax bill. It's a small but mighty silver lining that helps soften the blow of paying both halves. Let's put it all together with a simplified look at the calculation process. Step 1. Figure out your net earnings. This is your gross self-employment income minus all your legitimate business expenses. Step 2. Multiply that net earnings number by 92.35%. This is because the IRS says you only pay SE tax on 92.35% of your net earnings, not 100%. Step 3. Apply the 15.3% self-employment tax rate to that reduced number. This gives you your total self-employment tax. Step 4. Finally, you can deduct half of that total self-employment tax amount from your gross income for income tax purposes. So, armed with this knowledge, what are the practical steps you can take? The absolute first and most crucial step is to consistently set aside money for taxes. A common recommendation is to set aside 25 to 35% of every payment you receive into a separate savings account. This isn't your money to spend, it's future tax payments. Treat it like a bill you have to pay. When those quarterly due dates roll around, you'll have the funds ready, avoiding that dreaded panic and the risk of penalties. Make it a habit from day one. Next, meticulous record keeping is your best friend. Get into the habit of tracking every single dollar earned and every single business expense. Use accounting software, a spreadsheet, or even a dedicated notebook if that works for you. Take photos of receipts immediately. Categorize your expenses. This makes tax time infinitely easier and ensures you claim all the deductions you're entitled to. The more organized you are throughout the year, the less stress you'll have when those tax deadlines loom. In today's digital age, there's no excuse for messy finances. Leverage technology. Many accounting software programs like QuickBooks Self-Employed, FreshBooks, or Wave can automate expense tracking, send invoice reminders, and even help you estimate your quarterly taxes. There are also specialized apps for mileage tracking or receipt scanning. Investing a little time or money into these tools can save you countless hours of headaches and potentially thousands in missed deductions or penalties. They are an essential part of reclaiming control. Don't just set it and forget it. Regularly review your income and expenses throughout the year. Your business might have a great quarter, or a slow one. Your estimated tax payments should reflect these changes. If you have a particularly good quarter, you might need to increase your next estimated payment. If things are slower, you might be able to adjust down. Regular check-ins prevent overpaying or, more commonly, underpaying and facing penalties. Think of it as steering your financial ship, making small adjustments as you go. The ugly truth about self-employment tax isn't that it exists, but that many people discover it too late. The real power lies in proactivity. By understanding what self-employment tax is, how it's calculated, and how to plan for it, you transform from a reactive, stressed entrepreneur into a proactive, confident business owner. Knowledge isn't just power here, it's financial freedom. It means you can focus on building your business and serving your clients, rather than constantly worrying about the taxman. While this video provides a solid foundation, remember that taxes can be complex. Don't hesitate to seek professional help. A qualified tax professional, like a CPA or an enrolled agent, can offer personalized advice, help you maximize deductions, and ensure you're compliant with all tax laws. The money you spend on a good accountant can often save you much more in missed deductions or avoided penalties. They're not just for the ultra-rich, they're for anyone serious about managing their financial health. The IRS website, while sometimes intimidating, is also a treasure trove of information. They have publications specifically for self-employed individuals, estimated tax forms, and detailed guides on deductions. While it might require a bit of patience to navigate, these resources are free and authoritative. Knowing where to find official information can empower you to double-check advice and deepen your understanding, ensuring you're always acting on accurate, up-to-date guidance directly from a source. You now have the knowledge to reclaim your narrative around self-employment tax. It doesn't have to be a nightmare. It can be a manageable part of running a successful business. Instead of fear and dread, you can approach it with confidence and a clear plan. This shift in mindset is incredibly powerful. It allows you to embrace the freedom and opportunities of self-employment without the constant shadow of unexpected tax bills. You're not just a freelancer, you're a savvy business owner. Remember Sarah from the beginning? After her initial shock, she decided to get educated. She learned about deductions, opened a separate tax savings account, and now uses accounting software to track everything. She still makes quarterly payments, but they're no longer a surprise. She understands why she pays them and knows she's contributing to important programs. Sarah is now an empowered entrepreneur, thriving in her freelance career, because she faced the ugly truth and chose to master it. You can too. Despite the complexities, self-employment is an incredibly rewarding path. It offers flexibility, control, and the satisfaction of building something of your own. Don't let the fear of self-employment tax deter you from pursuing your dreams. Instead, view this knowledge as a vital tool in your entrepreneurial toolkit. It's the cost of doing business, but it's a cost that can be effectively managed with proper planning and consistent effort. The freedom and potential rewards far outweigh this manageable challenge. So, what's your next step? If you're self-employed, start by reviewing your finances today. If you're thinking about self-employment, build tax planning into your business plan from day one. Set up that separate savings account. Start tracking your expenses diligently. And don't be afraid to consult a professional. The ugly truth about self-employment tax only remains ugly when it's hidden. Bring it into the light, understand it, and you'll find it's a completely manageable part of your journey to success.